Today we're looking at 15 real estate exam questions on fixed rate and adjustable rate mortgages. Good luck. What is a defining feature of a fixed rate mortgage? A. Interest rate changes annually. B. Monthly payments vary. C. Interest rate remains constant for the life of the loan. D. Payments are interest only for a set period. C. Interest rate remains constant for the life of the loan. A fixed rate mortgage has a stable interest rate and monthly payment throughout the loan term. Which type of mortgage adjusts the interest rate periodically based on an index? A. Fixed rate mortgage. B. Adjustable rate mortgage. C. Reverse mortgage. D. Jumbo mortgage. B. Adjustable rate mortgage. ARMs have rates that fluctuate based on market index changes, typically after an initial fixed period. A 5-1 ARM means fixed rate for 5 years, adjust yearly after. B. Adjustable rate for 5 years, then fixed for 1 year. C. Interest only for 5 years. D. Loan is paid off in 5 years. A. Fixed rate for 5 years, adjust yearly after. In a 5-1 ARM, the interest rate is fixed for 5 years, then adjust annually thereafter. One advantage of an ARM for borrowers is A. High initial interest rate, B. Predictable payments, C. Lower initial interest rate compared to fixed rate, D. Guaranteed no increase in rate. C. Lower interest rate at the beginning compared to fixed rate. ARMs usually offer a low initial rate, making them attractive for short-term homeowners. What is the major risk of an ARM? A. High closing cost. B. Negative amortization. C. Interest rate increases over time. D. Lower monthly payments. C. Interest rate increases over time. As the market index rises, so can the interest rate and monthly payment of an ARM. What is an interest rate cap in an ARM? A fee charged on an adjustable rate loans. B, the maximum the interest rate can change. C, the starting rate of a loan. D, the final interest rate after the loan term. The maximum the interest rate can change. Explanation. Interest rate caps limit how much an ARM's rate can increase at each adjustment or over the life of the loan. Before we move on with the other questions, please subscribe, hit our like button. It helps us out in the algorithm, helps us get our information out to others, and helps this channel grow. Also, check out our channel. We have hundreds of real estate exam questions that'll help you pass your real estate exam. Which borrower is best suited for a fixed rate mortgage? A, someone planning to sell in 2 years. B, someone wanting consistent payments over 30 years. C, a house flipper. D, someone with poor credit. Someone wanting consistent payments over 30 years. Fixed rate loans offer payment stability, ideal for long term home buyers. A borrower expecting to move in 3 to 5 years might prefer an ARM because A, ARMs offer lower monthly payments, B, ARMs have higher down payments, C, ARMs provide a balloon payment, D, fixed rates are easier to refinance. A, ARMs offer lower monthly payments. The lower initial rate on the ARM can save money for short-term homeowners. What does the margin in an ARM refer to? A, the loan-to-value ratio, B, the bank's profit added to the index, C, the borrower's credit score, D, the maximum interest rate. B, the bank's profit added to the index. The margin is a set number added to the index rate to determine the ARM's interest rate after the fixed period. What is the purpose of a lifetime cap on an ARM? A, limits the number of years the loan lasts. B, limits total interest the borrower pays. C, limits how high the interest rate can ever go. D, limits refinancing opportunities. C, limits how high the interest rate can ever go. The lifetime cap protects borrowers from extreme interest rate increases over the life of the loan. A borrower with a tight budget who values stability should choose A 3-1 ARM, B interest-only ARM, C fixed-rate mortgage, D 10-1 ARM. C fixed-rate mortgage. Fixed-rate loans provide predictable payments, ideal for budget-conscious buyers. Well, please subscribe, hit the like button, hit that notification bell, and check out our channel. We'd really appreciate it. We have hundreds and hundreds of questions that'll help you pass your real estate exam. What typically happens after the fixed rate period of an ARM expires? A, the interest rate remains fixed. B, the loan becomes due in full. C, the interest rate adjusts periodically. D, the borrower must refinance. C, the interest rate adjusts periodically. After the initial fixed term, ARMs enter an adjustment period with rate changes based on the index. Which index is commonly used to adjust ARMs? A, LIBOR, B, GDP, C, unemployment rate, D, prime cost. A, LIBOR, or its replacement like SOFR. ARMs are tied to financial indices such as LIBOR or SOFR, which help determine future rate changes. What is a disadvantage of fixed rate mortgages? A, interest rate is uncertain. B, typically higher initial rates than ARMs. C, limited to government loan programs. D, not eligible for refinancing. A, typically higher initial rates than ARMs. Fixed rates usually start higher than ARMs, reflecting long-term interest rate risk. If an ARM has a periodic cap of 2%, what does that mean? A, the interest rate can't increase more than 2% over the loan. B, the interest rate can only increase once. C, the rate can't go up or down more than 2% adjustment in the adjustment period. Or D, the initial interest rate is 2%. C, the rate can't go up or down more than 2%. A periodic cap limits rate changes per adjustment to protect borrowers from large jumps. Well, I hope you enjoyed these 15 questions. I hope you did well. Please subscribe. Take the time to hit that notification button so you don't miss any of our videos. It's free to do so. Also, check out our channel. We have hundreds of questions to help you pass your real estate exam. If you have a question, ask it in the comments below. Have a great day.